What if I told you that by 2025, a single ETF could be generating more money for you each month than your 9-to-5 job? The upcoming dividend projections suggest this isn't just wishful thinking. In this video, I'm going to show you exactly how investing in SCHD with just $10,000 initially and $500 monthly contributions transforms into a substantial passive income stream. Imagine unlocking a financial vault that steadily fills while you sleep. And here's what makes this opportunity unique. It's emerging during one of the most volatile economic periods we've seen in years, creating a rare window for strategic investors to position themselves. While everyone's panicking about a potential 2025 recession, tariffs, and market volatility, one ETF is quietly positioning for massive gains. Let me show you why. The economic forecast for 2025 looks increasingly turbulent. We're facing a perfect storm of recession fears, climbing interest rates, and geopolitical tensions, sending shockwaves through markets. This uncertainty has triggered what Wall Street calls the growth-to-value stock rotation, the market's natural pivot away from high-flying growth stocks toward more stable, established companies when economic conditions deteriorate. Investors are actively seeking shelter before the storm hits. This is precisely where SCHD enters the picture with a distinct advantage. Unlike many popular ETFs heavily weighted toward tech and growth sectors, SCHD has built-in protection with approximately 30% of its holdings in healthcare and consumer staples. Think of these sectors as your financial umbrella during a downpour. When the economy gets soaked, these industries remain relatively dry. When people worry about their jobs or tighten budgets, they continue buying medication and essential household items, creating a natural buffer against market turbulence. The numbers tell a compelling story about SCHD's resilience. During market corrections, when portfolios typically take their hardest hits, SCHD has demonstrated remarkable stability with a maximum drawdown of only minus 21.54%, compared to the tech-heavy QQQ's much steeper minus 32% decline. That difference could preserve thousands of dollars of your hard-earned money during market downturns. Annual performance data reinforces this protective advantage. While popular ETFs like QQQ have experienced devastating annual losses of up to minus 32%, and even the broadly diversified SPY has seen yearly declines of minus 18%. SCHD's worst annual performance was just minus 5.56%. That's not just slightly better, it's dramatically better protection for your capital. The secret lies in SCHD's underlying companies. These aren't speculative startups, but established enterprises with sticky business models, providing products and services that customers continue to need even when times get tough. Now that we understand the storm, let's see how SCHD stands as your financial lifeboat in the turbulent seas we're heading into for 2025. SCHD's defensive positioning isn't just about playing defense. It becomes an offensive advantage in certain markets. When volatility increases and other sectors experience wild swings, SCHD maintains more consistent dividend payments. While investors in volatile ETFs might see their income streams fluctuate dramatically, SCHD provides more reliable dividend payments, giving you peace of mind and the foundation for any serious passive income strategy. Consider the psychological advantage too. Most investors panic and sell at the worst possible time, during market declines. As an SCHD investor, the smaller drawdowns and continued dividend payments can give you the confidence to hold through turbulence or even add more shares at discounted prices. There's also a mathematical reality working in your favor. When markets eventually recover, you'll be starting from a higher floor. If your investment dropped 21% instead of 32%, you'd need less of a recovery to reach your original investment. This means SCHD investors can potentially reach new high-water marks faster when markets turn around. Starting from that higher floor doesn't just mean faster recovery, it creates the foundation for something much more powerful. What if I told you that a modest $10,000 investment today, plus just $500 monthly, could be the blueprint for eventually replacing your salary? Many assume that creating job-replacing income requires massive capital, but there's a mathematical advantage most investors completely overlook. $10,000 seems too small to make any real difference, you might be thinking. Or perhaps, building meaningful wealth with such a small amount would take forever. These concerns are understandable. However, the math reveals a different reality, one where consistency ultimately matters more than your starting capital. Let's break down the exact blueprint. We're talking about a $10,000 initial investment in SCHD, followed by $500 monthly contributions throughout 2025 and beyond. By the end of 2025, your total invested capital will be $10,000 plus $500 times 24 months equals $22,000. This forms your foundation. Implementing this strategy is straightforward. Brokerages like Fidelity, Vanguard, and Charles Schwab offer commission-free ETF trading. The critical step is setting up automatic investments. Think of these as building blocks you stack methodically each month. Each $500 block joins your structure regardless of market conditions. Most platforms offer dividend reinvestment plans, DRIP, automatically converting your dividends into additional shares, accelerating your growth like a snowball gaining size rolling downhill. Here's how this works in practice. When SCHD trades at $80 in January, your $500 buys 6.25 shares. In February, if the price drops to $75, your $500 purchases 6.67 shares. By March, when prices rebound to $85, you acquire 5.88 more shares. You've accumulated 18.8 shares at an average cost of $79.79, despite the average market price being $80. This small advantage, buying more shares when prices drop, compounds dramatically over time. The compounding effect becomes even more powerful with dividends. At SCHD's current yield, your growing investment generates increasing dividend payments every quarter. These reinvested dividends purchase additional shares, which then produce their own dividends. Your income-generating assets continuously expand without requiring more contributions from your pocket. This approach offers psychological benefits too. Market volatility becomes less stressful when you're consistently investing the same amount monthly. Price drops transform from worrying events into buying opportunities. This mindset shift can prevent emotional mistakes that derail many investors during turbulent markets. By December 2025, your $22,000 investment will likely be worth significantly more due to market appreciation and reinvested dividend. More importantly, you'll have established an income-generating foundation that continues working whether you add more money or not. This strategy isn't about getting rich quickly. It's about building a reliable income stream that grows increasingly powerful over time. The beauty of dividend investing is that it generates income without requiring you to sell assets. Your principal remains intact while producing cash flow that eventually can replace your paycheck. The beauty of dividend investing doesn't just exist in theory. It comes alive when we examine specific projections. Did you know that even if SCHD performs at its worst-case projections through 2025, your $22,000 investment could still grow to $26,000 and generate steady monthly income without selling a single share? Smart investing requires preparing for multiple outcomes, not just focusing on the most optimistic headline. This scenario analysis helps you make informed decisions and keeps your expectations grounded in reality. What's fascinating is how divided Wall Street analysts are about SCHD's future through 2025, with projections ranging widely from $271 to $329 per share. Let's explore what each potential scenario means for your portfolio by 2025. In the best-case scenario, $329 per share with 4% dividend yield, your $22,000 would grow to approximately $30,000. This would generate about $100 in monthly dividend income. Imagine checking your account each month to find that extra $100 deposited automatically while you've been living your life. The base case scenario, $300 per share with 3.5% yield, would still grow your portfolio to roughly $28,000 while generating about $87 in monthly dividends. That's enough to cover several meaningful monthly expenses without touching your initial investment. Even in the conservative projection, $271 per share with 3.5% yield, your portfolio would be worth approximately $26,000 and produce about $76 in monthly passive income. This represents both growth and consistent income regardless of market conditions. Put these numbers in perspective. That $76 to $100 monthly could cover your phone bill, internet service, a package of streaming subscriptions, or utilities for a small household. This money arrives whether you're sleeping, working, or on vacation. True passive income that requires zero additional effort from you. The power of this approach lies in maintaining your principal investment. Your $26,000 to $30,000 remains intact, continuing to grow and generate more income over time. The foundation you establish becomes increasingly valuable. Historical patterns show that dividend ETFs like SCHD typically perform exceptionally well in the 5 to 10 years following periods of economic uncertainty. Patient investors who maintain their positions during turbulent times often see their dividend income accelerate as markets recover and companies increase their payouts. This strategy gives you options during market volatility. If you need the income, it's there. If you don't, reinvesting those dividends buys more shares, compounding your income growth for the future. What's truly remarkable is that in all three scenarios, even the most conservative one, you're building something with tremendous long-term potential. By the end of 2025, you won't just have a portfolio worth $26,000 to $30,000, you'll own an income-producing asset that could potentially grow for decades, eventually providing not just $76 to $100 monthly, but potentially hundreds or even thousands in passive income as time passes and dividends grow. That small monthly dividend check might seem modest now, but what if I told you there's a precise moment when your SCHD dividend income will actually surpass what you earn at your job? This isn't some far-off fantasy. It's a mathematical certainty with a specific date that varies based on your salary and investment approach. The concept I want to introduce is the crossover point, that magical moment when your money starts working harder than you do. This is the exact moment when the passive income generated by your dividend portfolio exceeds your active income from employment. For most people, this feels like an abstract someday goal, but with SCHD's consistent performance, we can actually calculate when this day will arrive for you. Let's talk about these timelines. With a $10,000 initial investment plus $500 monthly contributions, your SCHD portfolio would reach the crossover point in approximately 19 years for a $40,000 annual salary, around 22 years for those earning $60,000, about 24 years for an $80,000 salary, roughly 26 to 27 years for those making $100,000 plus. Think of this journey as climbing a freedom ladder. Each rung represents a milestone. First, covering your phone bill, then utilities, eventually your mortgage or rent. A significant psychological victory until you reach the top. Complete income replacement. Here's where the journey gets exciting. Increasing your monthly contributions creates a dramatic acceleration effect. Imagine your financial runway suddenly getting a turbo boost when you bump your monthly investment from $500 to $750, cutting 4 to 5 years off your timeline. Push that to $1,000 monthly, and you'll cut 7 to 8 years from your path to financial independence. Strategic lump sum investments create what I call timeline jumps. Investing your annual tax refund of $2,500 as an additional contribution could reduce your timeline by 2 to 3 years. Similarly, directing half of any work bonuses towards your SCHD portfolio generates additional momentum. SCHD's historical dividend growth rate of approximately 11% annually creates a powerful snowball effect. Each share generates more income every year, gathering momentum like a snowball rolling downhill. A $1,000 annual dividend today becomes $1,110 next year, then $1,232, with the compounding effect accelerating dramatically in later years. For those wanting to calculate their personal timeline, the formula is straightforward. Take your annual salary and divide it by SCHD's current dividend yield, approximately 3.5%. This gives you the portfolio value needed to replace your income. Then, using a compound interest calculator, determine how long it will take your current investment strategy to reach that amount. For example, a $60,000 salary would require a portfolio of approximately $1.7 million to fully replace with dividend income. Using our investment strategy and SCHD's historical performance, this equates to the approximate 22-year timeline. The beauty of this approach is that, unlike withdrawing from a retirement account, you never touch the principal. Your dividend income continues indefinitely and will likely increase over time as companies raise their dividend. Plus, you're building a legacy asset that can be passed down to future generations. Many investors accelerate their timeline by increasing their contribution rate as their career progresses. A promotion, raise, or side hustle can all feed additional capital into your SCHD strategy, potentially cutting years off your income replacement date. With only 15% of Americans feeling financially secure, imagine the peace of mind that comes from joining this select group. This SCHD approach isn't merely about growing wealth. It's about reclaiming tranquility in a world where financial anxiety has become the norm. Research shows people with passive income report significantly higher life satisfaction. Starting with $10,000 and adding $500 monthly creates a pathway to waking up without money stress weighing you down. The beauty lies in its simplicity. No need to time markets perfectly or predict economic shifts. Each small step builds towards financial security. Start today, because each month you wait is another month of stress in a sea of uncertainty. This strategy doesn't just build wealth. It transforms your relationship with money, delivering both practical returns and emotional freedom.